Welcome to Born to be Scaled, the show about building businesses that are designed to grow. I'm John Friedman, together with my co-host Sam Morehouse, and supported by Barry Cranford and his team. We speak with founders, builders, and investors about what it really takes to scale a company. Sam and I started our careers together on the grad program at Morgan Stanley, and after 20 years in finance technology, now both run our own businesses. In each episode, we unpack the real lessons behind scaling companies.
Well, welcome everyone, and please welcome our guest for today's session, Paul Budgen, who's here to talk to us about pensions and the interplay between industry, large and small, and government regulations. My own personal approach to pensions is I've always kind of trusted future Sam to be very wealthy and to sort out any kind of end-of-life care. But the real concern is that current Sam is getting older and grayer day by day. So really keen to see if Paul's going to get advice from me. And we're going to start, as always, Paul, going to give you some time and space to introduce yourself and to talk to us about your path to being here today, by way, please, of just mentioning the government regulation that led to auto-enrollment in pensions in the UK. Let's just start there.
Hi, everyone, and thanks very much to Sam and Barry for inviting me on. The 2-minute story about automatic enrolment in the United Kingdom is around about 2008. Tony Blair asked Adair Turner, who is now Lord Turner, who runs something called the Pensions Commission, a bunch of very bright people outside of the political mainstream, what we would probably call a quango nowadays, with the specific remit of looking at how we structure the pensions regime within the UK, and they came up with a bunch of recommendations. One of those recommendations was automatic enrolment. And to cut a very long story short, the report identified that about a third of the working population joined really good pension schemes, and 2/3 didn't. And this was a huge problem because they tend to be lower paid and they were going to fall back on the state. So the answer was to get them all to join a pension scheme. Now, we have the law of contracts in the United Kingdom, so it required statutory legislation to say you're in a pension scheme. If you're a worker and employed by a UK company, you are in a pension scheme unless you do something to opt out. So it was a nice fit of overcoming nobody's signed a bit of paper, but also for those who don't like to be forced in to do things, they had the opportunity to opt out. So you put a load of people in pension schemes, you started off with a contribution regime that was very small, and then over time, every employer had to do it. And then once everybody was in, contributions were then raised to the current 8% that we see at the moment. And we have another pensions commission having a look at version 2.0. That's my 2-minute version of it.
So from the outsider, when government gets stuck into an area of industry like this, the lever they tend to pull is that of regulation. And you might look at that change as being an opportunity for someone to go in and build a system that checks, regulatory compliance. You found that it was more about payroll data and speaking with compliance people in businesses rather than the pensions people. What was the change there?
It's a good question. It was a very difficult road. So I'm 30 years in the pensions industry. I would call myself an apprentice boy. I started at 18. I have always sold pension schemes, whether workplace or individual stuff. Everybody was looking at automatic enrolment, and we'd never had this before in the UK. This had never happened before. So we're all trying to figure out what it is we're trying to do. Now, if you just do what you've always ever done, you would go to financial advisors and you would say, can you select a pension scheme for me, put one in place for me and put my members into it? And that's what we had done for as far of 80 years. So that's what everyone knew. When I joined Nest back in the day, about 10 years ago, there were 2,000 members in the scheme. It was tiny. And I was asked to go and see financial advisors on the high street and tell them how great the charging was, tell them how great the investments were, and tell them how great the administration was, and could they see to it that they would put their employer clients into the scheme. I remember saying to the distribution director at the time, I said, how's it going? And he said, well, it's not very good. And I said, no, I know why. The charges are hideous. They're very expensive. The fund has got no track record because it's only just opened, and nobody trusts government to run a bar, let alone a new tech system. And that got me thinking. So I spoke to the guy who was running the strategy at Net, and he gave me 2 bits of advice that has stayed with me ever since. And that was understand the problem that you're solving and identify where the market failure is. Now, I don't know if you'd just done an MBA or if it was a course he'd just been on or anything like that, but it did get me thinking. And what I realised is automatic enrolment, despite its name and everything I've just said, is not a pensions problem. It was nothing to do about the pension scheme. It was everything to do with compliance with the law. The first time ever the law of the land had changed and said, Mr. and Mrs. Employer, you have got to set a scheme up. You've got to put people into it. If you don't do that, we're going to fine you 300 quid. And that was it. Okay, fine. So we need to be open for anyone who wants to use us. And we quickly identified a genuine, unique selling point. So everyone talks about their UPS being their customer centric, or they take service seriously, or something cheesy like that. And it's never really unique because everybody says that. But Nest did have a unique USP, and that was it had a public service obligation. It couldn't turn anyone down. A bit like the BBC, a bit like the NHS, that kind of thing. So we were thinking, well, okay, you've got lots of employers. A lot of them are unprofitable for the commercial market. We just need to go out and tell people that we're open. We've built the plug. You can just put your plug into it and we can run. The problem is the plugs we were asking people to put them into, all the data and all the processes were in payroll, and payroll were struggling to get to terms with real-time processing, which was the big thing in their world at the time. But we identified that what we needed to do was go to the payroll software providers, go to the payroll professionals, the accountants, and we need to say to them, can you build the API links into Nest to make it super easy? And crikey, it was like pulling teeth at first. But suddenly, the largest employers did it first. They all had their own kit. As soon as the SMEs started coming in, all the customers started saying to the big payroll software providers, where's your automatic enrolment module? And so all these customers were asking for it. If you were going to link into anyone, link into Nest, because we had the public service obligation. And we got the first 2 or 3 early adopters to change their kit. And then suddenly it became an avalanche. And where I started, 2,000 members in 5 years out of a population of about 8 million in the UK. Nest had picked up 7 million of those members. It was a kind of runaway success. It had a huge amount of market share. But just kind of in between that story, it was about this time at Christmas, I met up with a lot of old pals in the big insurance companies, and they were talking about automatic enrolment, and they had 50 installation managers or 40 onboarding managers, and how many did I have? And I said, well, I've got 4. And they were like, oh, you don't know what you're doing. And I said, well, I'm betting on payroll. Payroll's terrible. It won't work. Blah, blah. And they, laughed at me over a pint. You don't know what you're doing. 2 years later, when we wiped the floor with them, some of the directors of those companies were back into Nest to ask us how we did it. So it was really uncomfortable at that time. You do have to think differently, because for 80 years we thought one thing, but when it did pay off, it paid off in absolute spades. And then folks started coming to us to see how we did it.
The scaling factors obviously a kind of key metric and part of the success story. And I think is kind of music to any startup founder's ears. If you have government regulation that's directing organizations to use a service that's like yours, that's kind of the keys to the kingdom, right? But what I'm really interested in is you mentioned twice this public service obligation and how some might think that that's a hindrance, but you managed to turn it into part of your success. Just go back a little bit and give us some context as to what Nest is and why it has a public service obligation.
Good question. So the genesis of this was Lord Turner's commission had identified that a lot of the commercial providers found a lot of the business in that sector to be unprofitable. And they made quite a they kind of shot themselves in the foot. On the one hand, they said, we can't make money out of this. And I think they were thinking we were going to up the contributions immediately. But they said, no, we can't make money out of this. And so the government said, if the law of the land has changed and an employer has to use them and the commercial market won't help them, then we'll set something up called Nest. And then the commercial market moaned. They said, "Oh, crikey, that's not fair. We've got this private market that's working really well." And they said, "Well, okay, what we'll do is we'll put some restrictions on it, so it can't go outside its remit, but we will fund it via a loan." And it's quite an interesting little thing here within government, in that the charges are quite expensive relative to what you can get in the market. But it's used to fund the loan that government provided Nest in order to set the scheme up. So I think it's been in operation now, about 13 years. It's just about broken even. I think the debt's about £1 billion. But that £1 billion is an asset on UK PLC, also UK government, and Nest is now starting to repay that loan. It can't sell, it can't be aggressive in the market. It had restrictions on itself to start off with, but that was really to demonstrate market failure. At the time we were in Europe, you had to go to Europe and demonstrate a market failure, and they were able to do that. So yeah, it was quite a rocky journey.
The Nest, kind of the implementation of the new regulation, and an example of the government creating a market for UK pensions for people that either previously didn't have them, didn't have very good ones, didn't choose to enroll in them. And the existing market, the incumbents, saw the previous pensions world, decided that there wasn't enough enough money in it.
So if you talk to an actuary, they'll talk about the profitability within a workplace pension scheme is determined by how much turnover you get in it. UK PLC is around about 20%. So like 20% leave, 20% or 21% join, and a business slowly grows. When that happens, commercial market can provide a pension scheme. The problem with very small stuff or very unprofitable business is the turnover is a lot higher. And I think the highest turnover we got at Nest was something like 130%. People were staying for 6 weeks. The big franchise fast foods outlets, they were going through staff like socks. There was no commercial provider, there was no commercial model that was ever going to make money on that, but they were obliged to offer something. Some of the more intelligent people in the commercial sector said, be careful what you blinking well wish for, because we would make no money over there and it would destroy shareholder value. Let Nest do that, crikey. Let them get on with that, and then we'll do the ones, the 200 lives city lawyers all on £1 gajillion each. They're the ones that we want to do business with, and we'll make money there. So there was an argument about letting Nest get on with very unprofitable business lines because it was funded by a government loan.
Oh, all right. So then draw out, because they were unprofitable business lines funded by a government loan. How do you make money? How do you turn that kind of regulatory? Like, a lot of people from the outside world look into regulatory, like heavily regulated industries, and think thanks but no thanks. Like, the costs are going to be too high. So how do you make money there?
You have a balanced book. So you've got a bunch of unprofitable stuff, then you've got a bunch of profitable stuff, and then you kind of balance that book. But one of the unintended consequences we found is you would have, if you're an employee in one of these unprofitable businesses, you kind of went to the sister unprofitable business, and then you left and went to the other. So you always had a Nest had a pot, tried to do a pot for life. So the people were churning around this ecosystem that always had a Nest account. And because Nest got scale, it was able to cope with that a lot better than if you're a commercial provider and you only had one employee in one sector. Nest was very sector specific, like not entertainment, but hospitality industry. 90% of the hospitality industry uses Nest. Therefore, the employers were putting people into the same pot they had. The unit costs were relatively low compared to the commercial sector, but you also wrote some really profitable stuff. So you ended up with this balance. But I would go back to, we as a society, when we are law abiding, we take, if the law of the land changes 99 times out of 100, we obey it. So you couldn't have a situation where nobody could put employees into a pension scheme. So Nest had to exist just to do that bit. And there was talk about, well, Nest will never make money because it'll only do the unprofitable bits. But as it turned out, it did the profitable bits as well. So it's worth doing a little Google search if you're really bored. A Google search of some of the commentary in 2012. Pretty much everybody said Nest would fail. Pretty much everybody said automatic enrolment fail. They'll say the opt-out percentage would be like 50%. You'd get mass disobedience from employers not signing up and things like that. And I think government were thinking around about there'd be a 20% opt-out rate. The naysayers were saying 50%. And I think it turned out to be about 93% of the people stayed in the pension scheme.
Is that like there's the people and the people, right? There's like the payroll people for an organization who, maybe are a little on the conservative side and likely to do, follow the law, right? But then there's also the people that hold the pensions who might be more inclined to kind of set it and forget it.
Oh, completely. Some of the stuff we got back, some of the feedback from customers, certainly younger people, was I'm being treated like an adult. I'm 25. I'm in a pension scheme. Oh, I'm a big boy now, and they quite liked it. But also the design of the Nest scheme, the design of the legislation, tipped a huge hat to nudge theory, and you can't.
That was big with Tony Blair, right? It was huge.
You cannot be. Yeah, you're the disciple of nudge theory if you've worked at Nest, because you had to do something to opt out. So you had to say, you got your pack and you went, no, I've got to go online. I've got to opt out. And then we say, are you sure you've opted out? Are you sure you want to opt? Yeah, definitely sure. Are you sure? Yeah. And then you could opt out. And then in 3 years, we put you back in. So, we're doing everything we possibly could do to keep folk in, tipping the hat to nudge theory.
You've spoken very highly of the people involved at the policy and the governance level. The way you describe, you said just now, as it turns out, it worked. And I think it sounds like it was a surprise to a lot of people. And if I can just drill down into why, you described a couple of emergent behaviors that you might not have known were going to happen beforehand. One example is that the kind of consumers of Nest policies are in industries like fast food, where people do tend to move from one job to another. And so the longevity of that kind of policy is surprisingly long, and turnover is quite low. How much did good luck and good fortune have in the success of the Nest organization and the policy?
There was a lot of good luck. There really was. I mean, unless I'm missing something, I don't remember seeing a deck of slides that said we were going to get 80% market share. I mean, that didn't happen. I think most people were saying optimistically we'll get 2 or 3 million people in, and that mean it will wash its face at some point. I think Nest's membership now is about 11 million, and it smashed it out of the parks. I think there were a lot of good people with a good North Star, looking at how do we get people into pension schemes and how do we get them saving for tomorrow. They will be better off having worked with us somewhere along the line. It was a little bit of private sector, it was a little bit of civil service smashed together. It had a tension. Everybody was a little bit grumpy. Nobody was high-fiving all the time, but it worked. So that was great. But I do remember when all employees were in, they then started to ratchet up the contributions, and all the insurance companies were talking about this kind of second wave. All the employers were now going to leave Nest in droves and go to all the insurance companies because there was a flight to quality. Never happened in a million years. And you just listen to the guys and girls who were talking about this, and you can see it was completely vested interest. I've got a sales target. I'm going to talk up this second wave. And hopefully nobody will remember the fact that I told them this a year ago and nothing's happened.
The big new thing happens to be the thing that I'm selling.
Yeah. I've got to pay Tarkwell's school fee, so I need more sales coming in. Can we start talking this market up? And the reality of it is, I would classify most people in automatic enrolment as reluctant customers. They didn't go into it because that they wanted to. They went to it because they had the sword of Damocles hanging over them, and if they didn't do it, they were going to get fined. So them saying to them, "Oh, you know that thing you really didn't like to do in the first place, you know, the thing you've just about got on top of. Do you want to start again and go somewhere else for like no benefit to you whatsoever?" I was like, "No, why would I do that?" So there was too much vested interest, too much self-interest, and not enough realism in the real world.
So talk us through that. Talk us through the next stage and Smart Pensions and your approach to mergers and acquisitions.
Well, so as much of a career, I just followed automatic enrolment. So I did 5 years at Nest, absolutely loved it. But staging, which is getting all the employers onboarded, was over. And my job really was to get as many employers on and to get as many members in. And I knew it was over. Now, I took a step back, and at the time, there were about 80 pension scheme providers in that market. Now, you pay an administrator, I don't know, 25, 30,000 pounds a year. There's a charge cap. There's only so much you can take out in the contract. I was looking at it, and no matter which way I looked at it, there was massive overcapacity. There was no way the market could support 80 providers. And this got me thinking. Nest couldn't do any M&A. It wasn't allowed to. So it just had to sit there. Smart was the new, bright, shiny fintech that had entered into the automatic enrolment probably a little bit late. It would have been much bigger had it done it a year earlier. I mean, it's not criticism. It's just a fact. But they had huge growth targets and potential. And there was a lot of chat about another piece of regulation coming in, talking about we now need to authorize all these pension schemes. So at the time, like you and I could have set a pension scheme, workplace pension scheme with a bit of paper and a stamp. And we'd have set one up, and it was insane. That's why you had 80, and some of them were absolutely awful. A lot of them were brilliant, but there were some that were awful. So the regulator said, right, I've had enough of this. We're going to do this properly. We want to see business continuity plans. We want to see disaster recovery plans. We want to see projections, business plans, and also we want £1 million in cash in the bank as regulatory capital. Now, as soon as they said that, I knew you would see that 80 go down to 15. I think it's about now 30 at the time. I spoke to the CEO of Smart, and I said, look, I think this is going to be a big thing. He said, well, come over, head that up for us, see where you go with it. And I did. So I came over, the regulation came in, and then there was a kind of race to get regulated. And all the ones that weren't getting regulated, I went around banging on the doors saying, if you don't fancy it, we're a really good place. We can take your customers, we can take your assets, we can pay you a bit of money, not a lot of money, and we can absorb you into our scheme. And Smart did more M&A than anyone else in the market at the time.
Smart as the young upstart in a world of very old, very conservative pension funds with huge City of London businesses. And
it was really strange. I distinctly remember being at the management meeting where I'd done the strategy, and I said, like, the biggest problem we've got, the biggest risk is all these large insurance companies have been around for 200 years and things like that. They've got massive pockets, very deep pockets. They will outgun us. So if we pay £1 a person, just say, for example, they could pay £10 a person, and when you've got 40,000, that's a lot. That's a huge difference. And they went, yeah, you're right. We can have a word with the people that are funding us, but to be honest, it is what it is. You're just going to have to, smile nicely, tell them how great we are, and hopefully hope for the best. So we did. And there were some very large schemes in the portfolio we brought over. I didn't come across one insurance company, not one bidded for it. And I was really, I didn't cry about it at the time. I didn't want to alert them to the problem that they, or the opportunity they were missing. But I spoke to an actuarial friend who was in consulting, and he said, he said, look, automatic enrolment, they've totally missed. You've got it at Nest. M&A, they've missed it as well. They've never done M&A before, ever. Maybe at big corporate level, but they've never done M&A through regulatory change. These government process and risk managers and the bureaucracy, it just takes too long to respond. He said, fill your boots, because by the time they get round to doing it, you would have bagged all the bargains, and he was absolutely right. So I was kind of surprised, disappointed, kind of happy, because I'm a shareholder in Smart Pension, and we were doing all the M&A bit.
It's kind of surprising. I remember, so, Paul and I did a prep call last week, and one of the things that struck me the most is that this is like a dissertation topic for an MBA, right? I mean, it's an old market with new elements that have been caused by a huge regulatory shift, quite conservative, lots of new money floating around, kind of free for the taking, really. If you forgive me a little bit, Paul, not to imply that you haven't worked very hard, but right, and these incumbents have just been paralyzed by almost like not noticing that there was a new market there. What was that paralysis about?
I think they were too busy pricing for stuff they'd always done. So there's an employer back on the market. It was in the market 5 years ago. They're back on the market now. Let's all fight this one out. And that's what they knew. That's what they absolutely knew. As soon as this new thing goes, they just didn't know what to do. And the governance is a good thing, but you can get over governance as well as under governance. And the over governance meant that they just weren't agile enough in their thinking and their processes to take advantage of it.
Yeah. So from the perspective of one of these smaller incumbents, one of these plans that had been set up in a hitherto fairly unregulated market, let's give it a go. Let's start a pension fund. How hard can it be? What is it that made Smart Pension an attractive acquirer? Like, why sell to you folks?
Oh, you see, the first year, the energy and the enthusiasm and the can-do and the fintech vibe was amazing. Nothing I'd ever experienced before. I mean, there was a little bit of that in Nest, because despite being government, it was a startup. But you walked into the offices at Smart, there was a snap, crackle, and pop, and it was a real can-do, exciting, energetical. We knew we were one page ahead of everyone else. Andrew, the CEO, he recruited folk from the pensions industry to give us bench strength. And so I ended up working with people who I'd previously been rivals with at Nest or had gone loggerheads at Trustees, but we're all on the same side now, so we're pals. But it was that, it really was a can-do attitude. It was small because of the tech was sat next to us as well, the tech team. It was, guys, you really need to do this because this is regulation. Can you squeeze this through? And they, look, we've come up with this great idea from a hackathon about doing this. Wow, no one's thought of that. Yeah, crack on. It was pensions and tech sparking off each other. So it was, it was a great place to be in the first couple of years. Yeah.
I guess that brings us to not quite to the present day, but to kind of the beginning of the story that leads to the present day, kind of post 2015. You'd had this career where you'd worked in pensions, you'd been in this world that was subject to various changing regulations, a number of, what you might think of as kind of save game points, where firstly the regulation shifted so that, guess what, everyone's got a pension now. Then industry shifted to make more contributions into people's pensions because it was, like a hiring strategy, presumably, like here's nothing that will do for you. And then once you got to that kind of economic situation, well, what else changes, right? People are cashing out early, people are not using their pensions appropriately, people are waiting too long, and that led to MyTime. So tell us a little bit about that.
So the folk who I work with at Smart and Nest will know all about this. So at Nest, we had this thing called Blueprint, which is looking at how to take money out when you've got a modest pension. At Smart, we built something called the Four Pots model, but they're all in occupational pension schemes. So I was taking all that energy, enthusiasm, and research, and then doing it for myself. But to kind of put it into context, this all started in 2015 when the then Chancellor of the Exchequer, George Osborne, stood up and said, if you've got a pensions pot, you now have the freedom to do what you like with it. You don't have to buy an annuity. You don't have to do the sustainable income in retirement. You can cash it all out. You pay a lot of tax, but you can do this. Now, this might surprise everybody on this call when I say this, but since 2015, there has been little to no innovation in that pensions space. for 10 years, literally none. The economics of the advisory model means that only about 9% of folk with at least £250,000 in their pensions pot can get advice. Therefore, everyone else is pretty much left to their own devices, YouTube, books, whatever it is. We've ended up in a hideous position where pensions freedom has created a scenario where a lot of people are cashing the whole thing in and paying a lot in tax. They're putting it in cash, so it's not invested. Inflation eats away at it, certainly in the last few years. And ultimately, they're going to run out of money, so they fall back on the state. It's the exact opposite of automatic enrolment. It's exactly what you shouldn't do, and that was the kind of problem we were trying to solve. Was how do we create a sustainable income in retirement for folk who are disenfranchised, for want of a better word, from the advice process? We use the 4-pot model, but we've invented something called Smart Annuity AI, which, using our model for folk with, say, 100 grand, will produce about 40% more income for them during the lifetime of their policy than traditional financial planning. MyTime's so at 50, I took a year off, went to university. I even stayed in halls. That's a different story, but I did that. During the afternoon, I wrote the business plan. A month after leaving university, I got a co-founder. 2.5 years later, we had our Christmas party yesterday. We have got an MVP. We've almost got regulated by the FCA. We should be launching in March to a market, hopefully, that's absolutely crying out for someone to help it.
Congratulations. What did you study at university?
I studied theology. I'm a lay reader in the Church of England. I call myself a baby vicar, and I went to Cambridge, and that's the picture there.
Excellent. Congratulations. So if the pensions thing doesn't work out, you've got a stopgap in the Church of England.
Like so let's see how that goes.
You're all set. You're all set. Unfortunately, the big job was just taken. So you'll have to work a lot harder. Well, good work. To get back to pensions, I guess that there's this understanding that post-Osborne, post-2015, something must be done, right? And usually something must be done is because something's going to break. What is it that breaks if there's no shift in the industry?
Look, if you're on 30 grand a year, you're not a high rate taxpayer. You've got 100 grand in pension pots. You don't know what to do. You're overwhelmed by it. You don't think it's yours. You have no ownership. It's Aviva or Standard Life or ABC employee. You don't believe, right or wrongly, that it's yours. And what people spend on average 22 minutes figuring out what to do, they cash it in. So they say, right, I'm going to cash that all in. I get a little bit tax-free, but the rest of it, 75 grand of that, is going to be on top of my 30,000. I'm going to be a high rate taxpayer, and I'm going to pay a load of money in tax. And then I'm going to stick it in my bank account, and I'm going to think I've done a jolly good job because I've never had 50 grand before in my bank account. Somebody in the pensions priesthood, as well as the priesthood of the Church of England, that is a terrible outcome because you're going to run out of money. But also, I would also make the point, I think HMRC have got blood on their hands because they took the tax, and they're quite happy to take the tax because you have freedom. You have freedom and choice in order to encash it. Now, that's problem number one. Problem number two, I think, is even worse. And that is where folk do invest that 100 grand. But the rule of thumb is you take 4% out over the year and blah, blah, blah. But you're so worried about running out of money, you take out 2% and you live in austerity. And then when you die, you give the kids back 134 grand. And the kids are going, hey, you could put the heating on instead of saving that money for us. So you've got you've got people with a kamikaze attitude that are going to crash and burn, and you've got kind of the miser Scrooge-like thing and not spending the money. So the psychology of our solution is we're giving you permission. We're going to tell you how much you can take out a month, but we're going to give you a financial resilient pot, a little cash pot on the side, and a little bit for the kids as well to give you, dignity in death. But the rest of that pot, we're going to take care of you, and we'll buy an annuity for you at age 80 when you should do. And by doing it that way in a controlled environment, we will produce for you 40% more income than if you try and work it out yourself.
It's pretty compelling, right? 40% is 40%. I guess that to drill down into the actual problem, there is a governance gap between the pensions regulator and HMRC, who have hopefully different interests. Although really, like you say, HMRC will blindly take your money without suggesting that there's a better way that might be a nicer way for you to live into your retirement, a nicer way to, you know, to give your family money. You might have more than you think. And then alternatively to that, it's very possible to get to retirement age without really having any financial education, having made a bob or two, but not a huge amount. And now because of this pensions policy, to roll into retirement with a half decent pension, but to still not know what to do with it, because if it's not over 250k, like you said, the economics of the thing, the way it works out, you can't afford good advice, and good advice is hard to come by. It's quite expensive. So MyTime fits in with this four pots that's modeled on hopefully human, like well-directed human behavior.
So, yes, well articulated. The financial regulator does accept they call it the advice gap. And they absolutely acknowledge it, and they've introduced something called targeted support, which hopefully will come into the market around about April time. Hopefully, I get mine out just before then, and that will come out in August. And basically, that's a guided way of doing it. So advice is do it for me, then cashing out entirely is kind of do it yourself. Targeted support, and what MyTime is kind of do it with me. So our theory is we're going to give you a default setting. You can get out of it if you want to, you can do whatever you like, but we're going to do nothing, and we will give you a sustainable income in retirement. Now, to your point, we used to have quite a horrible phrase back in the day where you look after people from 18 or 21 all the way through their working career. You've got trustees, professional advisors, all in the workplace pension schemes. You get to 65, and then we throw you in the shark pool. You go, there you go, look after yourself. And you've got
good luck
experience of doing that. You don't know who to trust. You want to buy crypto instead of a tracker fund, and all sorts of weird and wonderful things. But I think that is a very genuine challenge. Great job in accumulation. You now need to do a great job in deaccumulation. Now, interestingly, at the same time as targeted support, the government absolutely acknowledge that this is a problem in workplace schemes. So the Pensions Act 2025 has introduced trustees now have to give a default income in retirement. You can no longer just say, well, I gave you the options, it cashed out. Well, good luck to you. They can't do that anymore. And so hopefully our model for MyTime not only works for individuals, but we can also adapt it and kind of pivot into the workplace pension schemes market and talk to employers and trustees about how we can do it in an FCA environment.
Yeah, that's I didn't know that last piece about the shift, the kind of constant, some might call it an encroachment of regulation, but I'm from the UK. I'm very happy with our regulatory environment, right? as regular listeners know, I did just move here from the States, and I actually quite like being under the thumb a little bit. It's actually very comfortable and quite warm. You know, if you have lived your life working for a big company or a factory, or you've had that side of your financial affairs taken care of because your company has a payroll office or an accountant's office or financial control. And so fine, unless you go digging, it's likely that your income is right, that you're paying right amount of tax to pay as you earn. Nowadays your pension's being taken care of. But the second half of that was, off you go, good luck, and it. To my mind, completely appropriate that something's happening. I guess. So I do want to talk about that, but we've still got about 10 minutes left. So I'll hug that one in for a second. I want to talk about this 40% higher income over your lifetime. Now, retirement is getting longer and longer, right? But 40% is a huge number. Where does it come from?
Because the other products are terrible in their design. So I've spoken to the regulator about our equation and about how we do the product design. And I'm working with the University of Cardiff where they're stress testing and things like that. And they all come back to me and say, is it that simple? Is it that easy? And I say, yes, it is. It's not complicated. What you've got to remember is, first off, is think about the market. So retirement at age 60, think about physically, cognitively, is very different from 80. A 60-year-old and an 80-year-old are two different things. An 80-year-old, bit more daytime television. 60-year-old, you want to go out, you've got a bucket list, you might want to walk up Kilimanjaro or something like that. Okay? Now, because we do the 4 pots model, we give a lot of your money up front in the early years. And when you hit 80, we have a we use the later life pot to buy an annuity, which for folk who don't know, it's a contract with an insurance company that guarantees an income for life. But if you buy at age 80, you get something like a 12% yield, whereas if you do it at 60, you get a 5% yield, because at 80, you're not going to last that long. Years are behind you. It's got much more value for money, and it's much more attractive. So we give you a lot of your money up front in the early years. We then secure income in your later years when you need it the most. But we're using 75% of your pot to produce income. Whereas if you just invest it as a lump and just take 4% out, the lump just gets bigger and bigger and bigger and bigger and bigger. And you end up giving the kids, say on 100 grand after 30 years, you give the kids like 130,000. In my pot, I give you 50,000. So the £70,000 difference is paid to you in your lifetime. Now, when you're on a modest pot, only 100 grand, you've got £1 million, you've got 100 grand, having that 70 grand when you are alive is the difference between putting the heating on and not putting the heating on. And go onto Age Concern's website and see how many thousands of people in the UK now die of cold. It's thousands, maybe about 9 and 10,000. So there's a massive need for people to make the most of their money. And by putting in this design, having a watchful eye using our algorithm, Smart Annuity AI, we're super confident that 97% likelihood of achieving all of that over your lifetime. The slight exception is like if we have a 2008 market crash, then we might have to move some of the money around. But we've always got the basic state pension in the background. So it's just good design, conservative rationale, conservative assumptions, but it's also really good nudge theory communications. Get rid of the jargon. This is your money. This is how much you've got. I'm going to tell you how much you can get every month, and you've got a little bit of cash in case anything goes wrong, and you've got something for dignity in death. Right? Don't do anything else. You're fine. That's how we do it.
Yeah, almost set it and forget it, right? Don't think too much about it, and certainly don't go in and tweak it.
Once a year, you need to go in and say, I want to carry on with the income stream. But, fine. It's once a year. Don't do it every day and start trying to play the market. That'd be insane.
It's it's one of the areas, and it struck me as you were speaking just now, that it's completely intuitive. And in the light of day, what you're saying makes perfect sense. But emotionally, when you say spend more of your money up front, I'm not sure what the people in the call, how they felt, but I'm starting to get a bit clammy and my heart rate's rising because I'm like, retirement's a long time. I don't want to end up with nothing later on in life. I don't want to end up caught short. But
you're looking at 4 pots, and I'm saying this is your immediate income pot, £200 a month. This is your later life pot that should produce you, say, £150 a month when you're at age 80. Here's your rainy day pot. And logic says that's fantastic, but people always buy emotionally. And one of the things when we're thinking about it is we're recruiting customer service staff that can talk to 60-year-olds. No disrespect to 80-year-olds, but we're not having them on the phones talking to people who are concerned about their stuff. But the language you use, how you present it, your tonality, how you structured the page, it's really open, it's really transparent. This is what we're going to give you. We're not going to say get more of your money out up front or anything like that. That would be nuts. But we would be saying, trust us, this is what we're going to be able to pay you per month.
Yeah. Paul, thanks so much for speaking on a challenging topic with care and dignity and bringing a lot of transparency into the space. I want to end with one question, and then so how are you managing communications around stagflation in the UK? A great question.
Yeah, no, it is. So all roads for us and back to the algorithm. So the market. So we take responsibility for the investment of those funds. We've got 10% in cash. We've got 15% in diversified growth fund. We've got a bond fund, and then we've got a fund with high equity yield content within it. We look at it as a whole, and so all these things are moving at the same time. The first, from a design perspective, if we say we're going to pay you £200 a month, we have to pay you £200 a month. So we take a year's worth of income put it in a vault, and we drop it down £200, £200, £200, £200 that way. So if I tell you 200 and I give you 205, no one really cares. If I say 200 and I give you £199.50, they go mental. So I'm going to do the £200. Then on month 13, we go back in, we have a look at the performance of the fund. We either do another £200 or we can move some money around or move annuity purchase and things like that. We fine tune it every year, whether you've got markets smashing it out if the markets are smashing it, we can take a bit off. If they absolutely collapse, and then we can shift some money in. But the main thing about all of this is just communication. It's just telling people what it is in simple terms, and they can make a decision. How long does a pension transfer take? Sometimes it takes days, sometimes it takes weeks, but we have a dashboard saying where it is: red, green, amber. People want to know. They just want to know. Why do we have signs on trains that tell us that the train's 10 minutes away, or bus stops to say that the bus is 2 minutes away? Because people just want to know. They want to manage their own expectations. So that's what we're working super hard on.
We got one last question from Almanac about how you adjust your tone as economic sentiment has shifted this year. I think those two questions are kind of related, and it sounds like, telling people the grimy truth is better because they know.
This is a really good question. So there are some folk out there, they've got tech solutions, and they'll say, tell us how much your budget is. Tell us what you need as a minimum to do it. 9 times out of 10, once you've done that, you realise you haven't got enough in your pension pot. 9 times out of 10. And the feelings you have around that are, you feel a bit stupid. You should have put more money in. 20 years ago, when you had the chance of upping that pension contribution, you didn't do it. That causes anxiety, that cheeses people off, and as a user journey, it's absolutely terrible. So we flipped it on its head, and we say, look, tell us what you've got, and then we're going to make the absolute most out of that money, and we're going to give you as much income and as much security as we possibly can with what you've got. How you then want to live your life, whether you get a second job or downsize, or you're waiting to inherit money from Aunt Mabel or whatever it is down to you. But for the moment, the only problem I'm solving is you've got a pot of money, and I'm going to tell you how much sustainable income you can get from that. Over to you, whether or not you want to buy it. It's to work with me, treat people like adults.
Wonderful. Thanks very much for those questions there, Paul. Thanks again for joining us. Thanks to everyone that's joined us today, and Merry Christmas to all of you from me and from Barry and from John, who's not here today. He's on holiday with his family. So Barry, over to you.
Thanks, Paul. That was fascinating. Really interesting to hear the story, and it sounds very close to getting quite exciting for you with MyTime. So thanks for sharing that. And one final thing, Paul, is there anything that we can do for you? Anyone on the call? So we don't know who's listening now, who's going to be listening in the future, but anything in particular, any asks that you've got, or anything that we could do to help?
If generally, if you've got a good idea, or you think I'm making a mistake or something like that, message me. I have been nothing but impressed about the fintech space in general, the energy, the enthusiasm, the willingness to help each other. I mean, I've worked in civil service and big banks, and crikey, and the difference is chalk and cheese. So generally, if you think I've got something wrong, message me, or you think you've got a solution to a problem I might have, please come and talk to me. I'll always take the call. I'll always set up a video call or something like that. It's a pleasure to talk to like-minded people.
Thank you for listening. You only get me on the edit this week. We'd like to thank our sponsors, RecWorks, Turntable and Quantfin. Thank you to Barry Cranford for his work organising the show, and thank you to Alex Villela, our editor. Join us next time to hear from James Jackson and Jack Ullman, co-founders of Bumper, about modernising the auto industry and scaling through COVID. This is Born to be Scaled.